high yield dividend warriors. Welcome back to Saturday Night Live.
The reason we know how to use margin because we know how to use margin. Because you don't know how to use margin, well, don't put it on us. Don't even ask us questions.
Oh, I got a troll on one of my YouTube channels.
At least I got some allies here.
Stand on my wallet, I'm 10 foot tall.
Hey Ryan, why don't you pull up Amazon's margins real quick?
Well,
We have to have you.
Is that somebody's vibrator going off? What is that?
I thought it was yours.
NAV erosion, cap erosion. Who give a flying fuck about that shit?
Why do there gotta be haters for everything? Hello, everybody. It is Saturday, 8:30 p.m. Eastern when this is premiering. Members will get this first, of course. If you're wondering why me and Fabio are dressed like a bunch of Italian men that would be sitting at a sandwich shop outside of a sandwich shop in Philadelphia, making inappropriate comments to people walking by, it is because we just interviewed the CEO of HITI, Roger Grover. I would highly recommend. I don't know how you haven't watched it by now, but yeah. Go watch that and enjoy it.
Point of correction, we put these clothes on after the interview.
Yes, after, of course. But of course, we have other holdings to discuss besides High Tide. We already kind of shared our thoughts on how the interview went. After the general consensus was we all really enjoyed ourselves. It was a good time. Blake was looking forward to this for a while, and I'm happy that we all enjoyed ourselves.
Hopefully we can get him back on again.
Yes.
Yeah, that would be the goal, wouldn't it? Obviously, this is a bit of a fantastic four right now, and we do have other holdings besides a High Tide. We could call it a High Tide roundtable, but I think there's more to life than just one single stock. Where do we want to start the conversation?
Well, High Tide just made a rather massive purchase in Germany. And this is going to open them up and expose them to the German medical wholesale import market where there aren't enough growers in Germany. And I'm predicting maybe 1 to 3 years where there's going to continue to not be enough growers in Germany. And it might sustain that way for a long time. But for right now, there's this huge opportunity where German consumers need more than this local supply will allow. And so Germany has been importing a lot of cannabis. And Canada is the global producer, and High Tide already has a relationship with basically every producer in all of Canada, and they have built out a menu of offerings that they're going to try to distribute into the German wholesale market. This opportunity is exponential up until saturation. So I was hearing numbers on the Dales report earlier that Guap was citing, and Guapo did a bunch of research ahead of time, and he was pretty sure that there's about 10 times as many recreational consumers in Germany as there are potential medical. So the recreational market is roughly 10 times bigger than the medical. And so right now we're tapping into the medical wholesale. And if Germany ever goes full rec, like if they ever pick back up the Pillar 2 initiative, the current government is rather conservative and they're probably not going to push that. But maybe 2, 3, 4 years from now, there'll be a new government voted in that will be more pro-cannabis and will fully recreationalize it. And that would really open the door the rest of the way.
Yeah, I was going to ask him if he was viewing a more liberal German government or more pro-cannabis is just kind of a cherry on top, or if he's just expecting that there's going to be a conservative government.
I think that it's just a matter of time. Eventually, a more liberal government will get voted into Germany, and that's when it'll happen. I don't know how many years that'll take, but I think it's an inevitability.
Blake, going back a few weeks, High Tide's been up 22%. The man in Washington, D.C., Donald Trump, is cannabis. It's good. We want it when it doesn't smell, though. But yeah, he's saying now he's considering reclassifying. Is this the euphoric hype or the euphoric run that we've been waiting for?
I can't tell, but I can tell you that this is exactly the distraction I was talking about. If you remember a few months ago, Donald Trump has a bag of distractions, and he's going to pull them out and wave them in front of the media to get them to talk about something else. And the more tensions ratchet up with this whole Epstein thing, the more he's just burning through all of his distractions. And last Friday, he pulled this distraction out of his hat and waved it around in front of the camera. And I can't tell if he's intentional. Like, is he going to go follow through with this? Is this just a noise-making event? I cannot tell. I can tell you that if it becomes a reality, if it becomes true, if rescheduling really does happen, there will be a huge rally. But what we're experiencing right now, this is the rally off of a rumor, right? This entire industry is very much hype and hope driven, and we just got a real elevation in hype and hope for the U.S. Now, HITI's a Canadian company, and this sympathy move we're seeing. Every other Canadian company is also seeing a little bit of a sympathy move off of what's going on in the U.S. right now. Just the elevated hype and hope situation.
Mm. Yeah, and I mean, I trust Raj. Obviously, just spoke to him, but like, I trust that he's not going to enter the United States if he doesn't think that it's going to be like accretive to the business, or he doesn't see. Obviously, there's giant potential, but he stated before.
He said he's not in a rush. Yeah. You know, when the opportunity arrives, he will go through that door, but he's not going to go banging and trying to get the door to open early. He doesn't need to, right? The company's going to do just fine. They've got plenty of growth opportunity available.
Plenty of work to do in Germany.
Plenty of work to do in Germany. And if they establish this business model where they're wholesaling from Canada, the world supplier, to Germany, a market with higher demand than supply, they could potentially take this same and just cookie cutter it to every other country as they all go legal. They're already going to have this infrastructure set up where they already have a menu of offerings. They'll just hire some local lawyers and make sure all the T's get crossed and all the I's get dotted, and then they'll start importing Canadian product into whatever the new country is, whatever the new market. Whether, I've been hearing stuff about Czechoslovakia, France, Great Britain. Most of the Western world, I think, is slowly transitioning into a situation where it's going to be treated more and more like alcohol unless you need it for medical needs, and then it's going to be treated like medicine.
Fabi, I'm a little upset you did mention your concerns about the Canadian economy to Raj.
Oh, that would be inappropriate for the time that we had.
I know.
But I think my concerns are pretty much abated just by them being the low cost provider. So and them being a product that is more of like a leisure or could be a coping mechanism, if anything, something that someone does to, kind of ease off a little bit. So, for example, you don't really say cigarette companies or cigarette sales go down during, a recession all that much.
What I like to cite is that during hard times, unless it's too hard, but during hard times, people reach for cheap emotional pick-me-ups.
Yep.
And that's donuts, that's lottery tickets, that's alcohol, and if you're an adult, that's cannabis. If you're a user.
Yeah. It's we've covered that a lot in past episodes. It's HITI's set up to do pretty good no matter like the economic condition, unless 2008.
A light recession might actually that could be huge revenue boon. Like a severe recession is bad for everybody, but this is a business model that should do really well in a light recession.
Yeah. Talked a lot about HITI. Blake, is there anything else you want to cover before we move on to some other intriguing holdings?
Not really. I'm just really happy with the path and the direction, and this Germany thing. This is better than I was expecting. It was worth the wait. That's all I really have to say about it.
I feel like a complete bitch now that I'm like suddenly bullish again because it was trading at like 220 and like 215 forever, and like everything else in the portfolio is going up, and it's easy to say, look back and hey, I should have bought then, but second elephant in the room, Dave.
Well, before we get to Dave, this is more pertinent. TSSI, as we're recording this, because this is released tomorrow, is selling off like crazy. Like crazy. But the reason for it, I'm telling you all right now, if you're bullish or you have capital, buy some live. Not live, but this is a buy. So
you're saying
context, so? Yeah, right now.
Oh.
So, and by the way, this is from the guy that sold in the close to 30. So,
yeah.
The reason, and I was waiting for something. Right now, Mark, I won't say his full name, but he's definitely doing questionable shenanigans right now, like he did right before the rally. So for whatever reason, he has a lot of influence on the stock because this is a retail stock through and through. So some of the criticisms Andrew and myself have kind of levied against the investor base is that it's very retail oriented. So people who really don't know how to read or comprehend financial statements. I'm getting the debriefing right now on the side here from what Mark is saying. And
Thank you.
it's clear. No, I'm not talking about you, Phil. Clear misunderstanding or misrepresentation of what happened in the last quarter, because that was another thing we were talking about. Was the quarter was actually excellent, but people are paying attention to some of the lumpier numbers. Again, that more shows that they don't really see what the company's actually doing.
Procurement, you mean?
Yes. So right now, the this sell-off is due to a YouTuber doing a live stream at this very moment, and he did this again. He did this before. The exact same thing that brought it down from, I forget what, it was like maybe 9. It brought it down to like 7, and that was before it rallied to 30. He's doing it again. So that's why I was kind of quiet. Is I was making my purchases, rebuying some of my shares.
Okay.
No, because you have to act quickly on this. So
I'm acting quickly right now.
I wouldn't blow your whole, because he
1%. 1%.
No. But if you're looking to allocate, I would allocate on moments like this. So I've just reallocated some capital to TSSI. I'm not near to building back my full position where it was before, but I did buy a decent chunk, I'll say. So
20 shares wouldn't hurt.
it all depends on your portfolio size and your target allocation. I won't say, because like if you're dealing with $1 million, $2 million, $3 million, $4 million,
Oh my gosh!
versus
Why
30,000.
is Schwab built for boomers? I cannot. I cannot.
There we go.
Boom.
All right.
Awesome. All right. Well, again, you
I'm
have to already be
bored.
bullish. If you're not bullish on this company, then don't buy it. But if you wanted to buy it, this is seems
Thesis
like
is
a
just
good
a
move.
lot of AI capex, right?
A lot of AI capex. They're doing a stock offering, or they did a stock offering, and
It was at $17. I thought that
Correct.
was the reason that it was dropping.
No.
Actually.
No, right now at this very moment, there's a live stream happening, and he's talking very bad things about the stock.
Saying bad things.
Saying bad things. Stock down, stock bad. But in all honesty, like talking about the fundamentals, then we'll move on to Dave. The issuance is actually a very good thing, because if you listen to the earnings call, they said that they're at capacity already. If you conclude that data center capex is not done growing, the very thing you want them to be doing, and if they're already at capacity, is to build out more capacity. So this is no brainer. And one telling sign is that the executive team has not been selling shares, but at the same time, you have this massive opportunity set in front of you that you want them to capture. So how are they going to capture it? Through debt and share issuance. That's the times when you want the company to consider those things, just like how you would want HITI to consider those things. If the return on investment is going to be, X in multitude order of magnitude over the capital invested, you're going to say to yourself, how much more capital can we get out there to build it out? Now, it's not all sunshine and rainbows, because you won't know when the story ends listening to these guys, because they don't have a lot of, vision into like when that capex starts to come down. But as long as you have the confidence to say the capex is probably going to continue to go up from here, which going into 2026, I think that's a pretty reasonable assumption, then they have still a lot of runway to grow into. So I just needed to throw TSSI out there because of what's happening. Not because we had it scheduled, but let's move on back to.
I'm now a shareholder, so but the whales are entering.
You're gonna have to sit down and read some quarterly earnings reports.
ICOM is good enough for the allocation I put.
We will be talking about it going forward now, because it's back down to where Andrew was like, no, this is crazy. Retail's crazy buying it here, because the peak was when a YouTube streamer, I won't throw shade and name names, but they basically were at the top. They were the exit liquidity. And then right now you're back down to a very reasonable price for the growth story. And even more so, I would not be surprised if, because he did it, by the way, this YouTuber who's doing it right now, doing this to buy in shares. And by the way, this person was in trouble with the law. this person was in trouble with the law before, but I won't
And
say
it's
names.
not the Oracle, huh?
No, it's not the Oracle.
Can you put it in the private chat, Fabio?
How did my options not go through? Freaking Schwab.
All
Oh
right.
my god.
Fiscal, how allocated are you?
So
You're
I
like
still have
10%
1,000
probably.
shares left
Oh.
from my initial thing. Like I basically sold across all accounts about half of the stock, and I had some calls that I bought and then sold when they went up like 300%. So I've also sold covered calls along the way. So I'm 100% just house money at this point, but do have 1,000 shares in one account, and I re-entered small in another account just now. Because
This guy is like the Oracle reincarnated, Fabio. Just looking at like the thumbnails and stuff, I get a very similar.
Like, don't get me wrong, he's doing a great service, right? I wouldn't want to be doing his work, right? Because what he's doing, if I did it, I would be in a lot of legal trouble. But he's doing great work for me. He's been doing great work for me for a while.
So around like 25, 30, you think's a good exit price?
And to clarify, great work in the sense of like the ethereal, like providing opportunities without us even knowing each other. Just him doing his thing. If you understand, this is why you can't borrow confidence. So what in effect his follower base is just borrowed confidence, and so they just listen to him, right? And so when he's saying something, they're acting upon it because it's just borrowed confidence. They don't actually know what's going on with the company, and they're not fundamentals based. I think a lot of those guys are technicals based, anyways. On top of that, but yeah, well, I don't want to. If you want to go on to Dave and other stocks, we can.
Well,
this is interesting. I'm a shareholder now.
Before we move on from TSSI, I mean, this makes me think of that Fin2 or whatever you want to call him. He's on FinTwit. He was like saying he was 70% in the thing and didn't seem to understand the difference between like procurements and integration and stuff. And he's just freaking out over the revenue number and not looking at the segments at all. It's absolutely crazy that somebody could have that much of their money in something and like not understand very basic facts about it.
Jeremy Lafarve promoted companies with negative gross margins. Like people will buy anything that's hot trash and justify it using their own like twisted logic and stuff. I've seen it a bunch of times. Even people that are somehow financially literate will still buy hot trash, trying to tell themselves, "Oh, this time it's different."
Yeah. But now that the market's closed and I can't do anything else really with TSSI options magic.
I timed it. Okay, we want to move on to Dave. Okay, Fabio, I heard a number of your allocation to Dave right now. Is it close to like the 15 range?
No, not now because it's come down.
Oh, I see.
Yeah. So and you're referring to, because for full context to explain, right? I have the personal holdings and the holding co. Holding co is everything I update for CM, and my personal holdings, personal holdings.
Yeah.
So for the warrants, which is a bit, what's not irresponsible, it's just the warrants were an initial allocation of 5%. And then the warrants went up to in the teens percentile, and then they've come down. So lots of volatility in those warrants. But the initial allocation, which to be frank, 5% is very aggressive for that product. So not to be replicated. Yeah, not financial. I do not replicate that. If I was being asked by a family member, I would never suggest they would put 5% in the warrants. But now we're talking the holding co or the CM portfolio.
Yeah.
It's been elevating a lot on the recent pullback, and so just trying to take advantage of the capital, let's say on the sides that I've had, and then just kind of deploying that. So right now it's sitting at mid single digits, so about 5-ish%, 6%.
Yeah.
I'm comfortable, by the way, with talking dollar figures in the holding co. By the way, it's fine.
Can you switch to a 6-month or 1-year chart?
Yes.
Yeah. It's up.
I don't get very much information. There we go. That tells me a story. The 1 day chart doesn't tell me. Like,
go back even a little bit further than that, because
go to click on the 1 year. Oh dang! Andrew's probably making out like a bandit on this thing.
So we have a industry expert in the club, and a lot of our understanding is, thankfully, because that's how you actually get an edge. You need someone who truly understands the product and the business, because they work in the industry.
Garzy?
I will not say a name.
I see.
But and it's someone that we are working with in the fund that we're starting.
I see. Okay.
So
we need to talk about your fund also near the end of this.
Oh yeah, of course.
Later. Yeah,
we can talk about that. So for Dave in particular, the story goes as follows. For a while, they had a different business model, one that relied on tips. So the tip model was controversial. They got in trouble with regulators, and there was the opportunity for people to collect cash and not pay a penny. That was an opportunity before. So all you had to do effectively was have good time management skills and schedule the payments in accordance with when you would need the payment, which I'm sorry is not a high bar to ask of anyone. It's a very low, you're basically very nihilistic if you feel that people are incapable of doing that. You're insulting them. However, if you can't, for whatever reason, time your payments at least a couple days before and receive money from Dave a couple days before your debts are due that you need the money for, you used the instant pay feature, which is that in conjunction with the tipping feature is how Dave made its money before. Now, regulators came in and says, I'm going to save the lower income people, and I am going to remove the tipping feature because I am alleging that it is misleading, it is coercion, etc. And I'm not saying the arguments were without merit completely. I see the angle by which they're getting to, but I often find it comedic when someone of good standing says something like that, because in effect you might be removing the good thing that they had going for them technically, because now the business model has changed. What does the business model change? Well, now there's no choice but to pay a fee, and this business model is actually vastly more profitable than it was before. So I jokingly say to critics who kind of make this is the tipping is evil, and it's like, oh, don't worry, you saved them. You definitely saved them. Now you say, don't worry, I'm going to protect you. I'm going to force you to pay a fee. I'm going to make force the corporation to be more profitable, which is in effect what's happened. And then also, I'm loving, by the way, the buy now, pay later videos, because it is of people who are not financially literate. Asmongold, when his takes on the buy now, pay later industry was hilarious, because they hold two arguments simultaneously. They hold the argument first that these are very attractive endeavors, and then simultaneously hold the argument that they're very unprofitable. Both arguments are both made in the same video, and it's a cognitive dissonance that's very apparent. But anyways,
isn't it that they're taking advantage of all these poor people that can't afford a burrito, but then at the same time, look at all this money they're losing. Well, are they taking advantage of people, or are they losing money?
Or are the people taking advantage of them? Who's taking advantage of who?
Right. Like, you can't, because if they were really taking advantage of all of these people, would they be losing money doing it, or would they be profiting hand over fist because they're taking advantage of people?
Payday lenders too,
or the other argument,
ridiculous fees.
I love this argument that in lending, you want to lend to people that can't pay you back. I love that argument. That argument makes me laugh all the time, because I'm like, yes, because as an investor, your mind opens up a lot more, because you start to look at these businesses. And I would ask this whole panel, would you consider a bank a good investment if its business model was to lend to people who wouldn't pay them back?
I probably have to pass on that one.
None of us would invest in it, but there are people out there.
Do they get subsidies or write-offs to balance it out?
No subsidies, no write-offs.
Looking for a loophole.
There are people out there that hold that in their brains. They say the business model that is super profitable for banks, the evil bank, is to lend money to people that won't pay them back. And I guarantee you, well, I won't guarantee you, because maybe your audience actually is like really astute and knows this stuff. But if we get a comment, I will laugh at it a little bit, because it's like very like classic Reddit comment or classic YouTube comment that I'll see on some of these videos. But anyways, so Dave's business model has changed since then. One other thing, the P ratio is very misleading there, because Google's not being correct. It technically, when you actually go through the numbers and break it out, and we're talking about after including SBC and all that into the expenses, it's trading at roughly an 18 times earnings.
Mm-hmm.
When you exclude SBC, because that could be a bit lumpy because that's tied to the performance of the stock, and then you want to look at earnings excluding SBC, you get to a much more attractive look of the company at closer to 10 times earnings.
But 18 times with the growth that they
Yes.
have.
Yes. Yes.
Yeah.
Which, by the way, we should note, you should be including SBC as a real expense.
Mhm.
But yeah, 18 times with the growth is very attractive. And there's a lot of levers for them to pull. So one of the most direct levers they have to pull is just expanding the amount that they can loan out. So right now it's up to $500. And that's a keyword, up to, because most people, when they start out, you got to basically prove yourself to the system that you're trustworthy enough to be given the $500. But the very next growth lever to pull is start expanding that to $1,000 and above that. And so that's number one. Number two is introducing a new product that is just adjacent to what they currently do, is actually a buy now, pay later product. So that's think of like the Affirms, etc. And a lot of people have a bad connotation when it comes to that. I did too for a long time. There's a YouTube video on Capital Mindset where I talk poorly about Affirm. You can go look it up. So do I stand behind those same words today? I'd say my opinion has changed. Now, at the time, it looks like I was super correct, because when I criticized Affirm, it was a piss poor investment for about 3 years or so. That had a lot to do with where they were at. Now, as facts change, as things change, my opinion will change. And for example, there was a live stream where I discussed the change of opinion with SoFi, because they made a big business model change. They changed how one of the parts of their business works. And so it's not that I think the valuation today, is attractive or anything like that, but the business itself went through a fundamental change that my prior criticisms have to kind of be swept to the side, because the management team did actually a really good job. Same with PayPal, by the way, because I was a critic of PayPal, which I'm now long PayPal, which we'll talk about, I guess, later in the stream. But yeah, if you have any questions on Dave, I just went on a.
I mean, I actually understand it pretty well. I've been doing a lot of personal research, watching every Andrew Marshall appearance on multiple platforms.
This might be the first money lender I've ever considered investing into, because I have no business investing into banks or anything like that. Me personally, it's outside of my circle of competence. But Dave's business model is so simple. They're just like payday loan sharks. There's really nothing fantastically complicated
except
about it.
They're not even loan sharky about it, because it's just a flat fee. It's not 800% interest or whatever you hear about from regular
18% per week.
You know what I akin it to? It's very similar to the ATM business model. Very similar. So when so a person doesn't go when they get money out of an ATM and it's out of network. They don't go like, oh, I just took out $10, but I paid like $2 in fees. They don't calculate the APY. They just consider it's a fee to get money, right? And then same thing when people will use the product, like where you use your credit card to get a cash, and you go to like any
the cash
merchant. Exactly. You don't really do the math in your head about what the APY is, but it's actually pretty high.
Yeah, it's like a $25 fee or something, and it's like if you like annualize it, or it's like, geez, I just paid like 39% or something.
Well, they're busy arbitraging the difference in fees, because they have to pay their own fees to process everything. But they're charging you more.
Correct. And I will add, if these guys are basically disrupting the payday lender space, which has a lot of really, I would say big issues. So the problem that they're solving, you want these guys to be the next standard of payday lending. Trust me. Payday lenders are a different beast, and a company like Dave and a few of their competitors, if this model really takes hold, all those old payday lenders, they're going to go out of business. It's going to be replaced with a much more, I would argue, transparent by comparison, because I get it. There's a lot of these arguments, and I'm not going to say they're without merit. There are people who have legitimate concerns, and then there's people that go above and beyond and start doing a little bit of things they don't really know what they're talking about. But by comparison, you really do want this to be the new standard in how people access or get wage access.
It's a better model, to be honest.
It's way better.
And delinquencies too. That's for people who are worried about that. It's basically just a customer acquisition cost, from my understanding.
Yeah. So delinquencies, again, it's a lot of like you prove yourselves to them because they're writing very short-term loans. And so if you are someone who's not going to pay it back, first of all, when they're testing the waters with you, they're probably not going to lose all that much money from you. And the way you don't pay them back is you have to have $0 in your bank account or close the bank account. You better not have any money coming in because as soon as money comes in, they actually can make a claim and take it directly from your account. So a lot of people complain about that. I find it funny. It's like you're complaining that they are holding you accountable to a loan you agreed to take out.
Yeah, it's like, hey,
That
this
makes
is
them
money you
bad.
owe them, like, and they're just taking what you owe. How is that bad?
You promised it.
Yeah.
Yeah.
No,
Like you agreed to that like that access up front. Like they didn't hold a gun to your head and force you into it.
Yeah. So you want to hear the bear case for Dave?
I do.
I believe, and I could very well be wrong. This is, and I'm not a perma bear. Okay. I believe we might be headed into a recession, and the best time to buy a company like Dave is not going into a recession. It's in the depths of the recession. Like theoretically when things are really bad and they have a problem with people paying them back and everybody's unemployment's crazy high. That is the time to buy Dave. Now, obviously, they're increasing the revenue, and right now is also an attractive time to buy Dave. But one of the things keeping me from it is, gosh, I see all these early signs of recession, and probably I shouldn't be buying Dave now. Maybe I should be strongly considering it 6 months from now, 9 months from now, a year from now. I'm not really sure when, but mid-recession, if it arrives.
You might love this counterpoint.
Yeah.
I think it's the opposite.
Oh.
Why? Okay. So
me too.
the customer of Dave is in perma recession.
Okay.
So that's one way to think about it. They are the class of people that is going through a tough time, which has a lot of churn because people think that's a doomerist outlook. No. The United States classes has a lot of churn relative to other countries, by the way. So that's an optimistic way to look at it.
We have both upward and downward mobility.
Exactly. Yeah. So there's a lot of churn. The same people, it's not always the same people the next year and the next year and the next year. So Dave is focusing on the customer base that needs wage access, which by definition are people that are going through tough times. So if we think we're going to go through tough times, what we're basically saying is we're expanding the pool of which people are going through tough times.
Did you see because I brought this up in CM that if we have a recession, it'll bring in a lot of new customers, and I call it the Dave wave.
The Dave wave. And I will address this point because their loans are short term. It is very different, Blake, because I agree with you. You know who you don't want to own? Whatever you do, please do not invest in a company that gives out loans, car loans, to low income people, because that's a longer term loan. You can't back out of that. You can't make a quick adjustment the very next week. Dave loans are 8 days. Very quick adjustment period. So Dave, as long as the management team is at least, the similar awareness as like, where is the economy right now? How aggressive are we going to be with our lending practices? Are we going to be, everyone gets $500? Or are we going to say, right now, no, a little bit less because of our risk-based algorithm, right? So just focusing on that, right? They actually probably are in a really good position relative to an example, a car lending company or a car lending lender. Or even a personal loan book. Oh, you want to own one of those? A 1 year, 2 year personal loan? Oh, those guys, Blake, those guys are cooked. But I would argue Dave in that scenario could probably be one of the best to navigate that and has an expanding pool of customers.
Sure.
During that
So both you and Fiscal are on the bandwagon that as revenue increases and they get this new customer base, that the rate of defaults is not going to become a problem as the recession approaches, if it ever happens. I think they can
pivot quickly enough that it's much lower risk than with other types of lending, for sure.
So, like, for example, if the light switch flips, just like with COVID, and instantly the economy is in a different state next week than it is this week, they're only out like 8 days worth of
they can pivot in like days to weeks versus
they can pivot much faster than a normal lender. That's a huge advantage. Yeah.
And again, the only way they don't get their money back is you have no money in that bank account and you close that bank account, there's no money going into that bank account. That's how they don't get, because if there's money in there, let's say you lose your job and that 8 days happens, you lose your job and then you still have some money in there, but you borrowed from Dave. Dave will take the money out from your bank account.
Okay.
Yeah.
You basically have to debank yourself if you want to not pay Dave. Literally.
Beautiful business model.
Yeah. So also to note, one thing that's been happening is they've redone their lending agreement with their banking partner. So they have now a new banking partner in Coastal Community Bank, which is one of my investments as well. And they actually got their interest rate lowered by about 2%. So part of it is they use a warehouse facility to make these loans. And then as they've been actually printing cash, to not think of a better way to say that other than printing cash, they've been starting to utilize more and more of their own cash, because if you're getting such a high return on investment, why not, right? So they're doing exactly what you want. And that's over time, as their cash continues to compound, you're going to see that interest rate reduction start to creep up, or creep down, I should say. So the cost that they're spending on that capital will go down, and then you will see, again, further profit driver there. So,
well, if a recession does arrive, I would be interested to see how this cycle plays out, because I've never paid attention to a moneylender during a recession. I've watched other industries during previous recessions, and like with most cyclical industries, and I'm not saying Dave is super cyclical. I think it only has a mild amount of cyclicality to it, probably, but with other cyclical industries, when things are really good and the stock price is really high, the valuations look really low, and it looks like the right time to buy. And then when the commodity or whatever that they're based off of crashes, everything looks really bad and valuations look unattractive. And it looks like the worst time to buy, but the opposite is true. When everything looks fantastic is when you should be selling. And when everything looks like they're about to die is when you should be buying. But if you only look at valuations and you only look at the present and you don't look at the long-term view, with cyclicals, many people will buy at the top and get pissed off on the way down and get upset because they don't realize it looked good because it's a cyclical, and you bought it at the peak because that's when it looks the best.
There's actually one bear case, because I have actually 2 points. So for the Federal Reserve Bank of Chicago, they had a study from looking at what happened to payday lenders, because this model didn't exist back then, it's even to the same extent. They actually saw increase in business activity. Their businesses grew, they expanded during 2008. During 2020, they didn't. Why?
Maybe because the 2008 was an organic crash and 2020 was more of an artificial sudden thing, like
subsidies.
Subsidies. Oh, okay.
Subsidies.
Okay.
That's why.
Yeah.
So they didn't contract. They just didn't expand. So it's funny to say, that's actually one of the risks you could think of, is if there's like some sort of, it's not really a risk though, because it's basically you're taking away their opportunity to expand massively, is all. Again, the Dave's current expansion is take market share away from traditional payday lenders. That's their current one, right? They can swallow up that whole market. Let's say they swallow up the entire market for that, hypothetically. Now they're going to move with the ebbs and flows of that market. And so what affects that market? So according to the data, it suggests that if you have a recession and then the government steps in and does crazy amounts of subsidy, starts cutting people checks, they won't expand into that, because they're not going to get this massive flight of customers that are going to come in and say, well, I need this kind of loan for now. And in something like 2008 happens, where it's a recession that you don't have this like massive, writing of checks, a normal recession, right? A one where we don't go crazy. Well, we don't go as crazy in some respect. Then in that, they have a temporary boost that they could have by getting all these. But again, there's the churn rate. Not everyone's going to be in a perma recession forever. They're going to come in, they're going to have their hardship, but most people are going to go out of it and they're going to recover. So that's something I wanted to talk about. Is in 2016, there's a study from 2016 about the 2008 recession and payday lenders. But
Blake, are there any other? We're doing a bit of a Dave pitch do here. Any other like concerns or questions?
Eventually, maybe this is actually something that where like it would be better if I were to go on Capital Mindset's channel and have him and Andrew sit me down and explain to me how to truly read between the lines on the financial statements of moneylenders, because I'm used to manufacturers and retailers and service providers, and the way everything is structured, I can read between the lines on those. I can see what efficiency is. I can measure competitiveness. With a bank, I have no clue how to read that, and that is a big part of why I've been avoiding money lenders for forever. Is because I can't read between the lines on their financial statements, and I doubt Fiscal or Ryan can, and I'm pretty sure Capital Mindset can, and I'm pretty sure Andrew can. And I just don't have enough of an accounting background or finance background. I took 2 years of accounting classes and economics classes. I took like 1 class of finance. I did not take enough to understand money lending as well as I know I need to be a certain level of competency to ever invest in a company like Dave. So my threshold for any company in any industry.
I don't really think of them as like a bank, though.
Yeah. So my threshold for investing in any company in any industry is I won't buy any unless I could contribute during a board meeting, right? I need to understand the company well enough to be a part of the conversation. I don't have to be the hotshot genius in the room, but I just have to be able to contribute. And with the money lenders, I just don't feel like I've ever had anything special to say or understood them well enough that I would be able to contribute. So I've never fallen above the threshold where I felt I was competent enough to invest in a money lender. Even though I know Dave is very simple, I finally understand it. I finally found a money lender that is simple enough to just be like, it really just does one thing. It does it pretty well.
Yeah. Because I will say, like, I feel the same way about like traditional banks. Like, it's like, wow. Sometimes there's things that are so hidden between the lines that you don't even know you should be looking for it. And unless you're an expert on banks, it can turn against you very quickly. And I'm not super comfortable like that. That's why you don't see me buying like Bank of America or JP Morgan. I mean, at one point in time, I might have had a couple of bank stocks, but the reason I'm out of them and not involved is because I realize this play with fire, and sometimes you get burned, especially if you don't understand that it's hot.
I've been more tempted for like Visa and MasterCard than to get into like a normal bank or money lender.
I think that even though it's not the exact same thing, it's more in the same realm of like they're kind of like they're just taking a little piece of each transaction in a way, except they are forwarding, they're advancing you the $500 or whatever, but they're just taking a flat piece of each 500 and turning it around, compounding it every 8 days or so.
They have a very stable business model. Both of those companies, that duopoly is not going to go away anytime soon.
But if they had, let's say Dave had like a portfolio of like mortgage-backed securities or something, I'd start to feel very uncomfortable then with being in the stock. But
I hope you've all seen The Big Short. It's a great movie.
Yeah, good old Michael Burry.
Do we want to talk evolution?
PayPal?
PayPal. All right, we'll do PayPal.
I think PayPal's a good segue because we're going from fintech to fintech.
Sure.
Yeah, that's good.
What's been going on with PayPal?
So I was early. I got in this maybe a couple months before they switched management. So I've been in this for a while. But Alex Chris, definitely, I'm glad he ended up being the
5 years. 5 years. Do the 5 years.
Oh, 5 year
5
chart.
years.
Yeah.
Also on Twitter, when you guys post on Twitter, don't you dare post a 1 day chart. That's the dumbest shit ever. Show me like a 1 year or a 5 year. Show me some context.
We'll do a UNH 1 day chart right after the show.
What's going on today?
Just to grind my gears.
So let's not get distracted from the fact that PayPal is at 69. Nice.
Very important.
Very important.
It's almost perfect. It's almost perfect. It could be 69.69, but
It could be. Probably was at some point today.
Yeah.
We just caught that.
One day chart.
No.
Yeah. So good old PayPal. So I think it's really funny. Everybody wants to talk about crypto and how it's the next big thing. PayPal is one of the few businesses that actually has a real world use case for stable coins where they can reduce certain transaction costs with them, especially international transactions. If they settle in the PayPal stable coin, they avoid a lot of like fees for like currency Forex type stuff. And people just kind of ignore it. In fact, that one day where there was that big news thing about stablecoin and like Visa and MasterCard fell off a cliff. Well, fell off a cliff. Had that drop.
That was when
PayPal
Andrew
went
came
down
on.
too. But it's like the thing that came out was, hey, did you know people can do the thing that PayPal is already like doing? And it's like, why'd they go down? So PayPal is horribly misunderstood in my opinion by the broader market, and that's why it can't catch a break. It's been in consolidation mode since like the middle of 2022.
What is the intrinsic value rising? Like, I see the share price. What's going on with the intrinsic value?
Well, what do you mean by? I mean, intrinsic value. When you say that phrase, I feel like that's kind of a loaded, a little bit of a loaded phrase.
So, if I was to sit down and do a discounted cash flow or a PEGI on this thing, how far under or overvalued do you believe it is?
Honestly, my sense of the valuation is that I thought it was getting to be around fairly valued when it was in the 90s earlier this year.
Okay.
But because of current management and how much better they are than previous management, I believe that there's room for them to push the needle up further. They made a decision to let go of some unprofitable growth in their Braintree business. So if you look at their margins over time, you'll notice there was a period where their margins kept going down slowly, even though their revenue growth was looking good and a lot of other things were looking good. And people were saying, oh, well, this is because people were coming up with reasons like it's because Apple Pay and Google Pay we're eating them for lunch. Cash App is destroying them. Funnily enough, Venmo is eating their lunch, which they own, by the way, was one thing I got in a comment on a video once. Venmo is so much better. How can you invest in this? It's like, bro, what do you want?
Breaking news I want to share with you guys, only share with your audience. Okay. So it's back to TSSI, very brief, because I want to.
Oh, boy.
No, this is actually big. This is actually big. So recall my comment. I'm not going to name the name. Again, keep him out because, first of all, let him do his thing. So in the live stream today, he shared a photo claiming that Dell is looking to cut them out. Dell's looking to cut out TSSI. Yeah. He shares a photo saying it's new, and he makes the claim nobody else knows this. So we have someone who's autistic as hell and has basically a photographic memory and watches all of his streams. Yeah. Doesn't comment or anything, just watches his streams, just keeps an eye on him. And we don't ask him to. He's just someone who just does it.
That's an amazing friend to have.
Yeah.
Well, that's the good part about having this network of people. Yeah. You find a lot of autistic people in an awesome way. I'm autistic myself. All right. So obviously, so the claim while showing a photo saying it's a brand new photo is a photo from, how old is this? From May. A photo from May. So either the person has dementia or they're lying for a reason. And it's causing the stock price to fall.
Possibly their memory has changed. There's a third option. I mean, people can be not intentionally lying and they're just remembering things wrong. I have come across that. I'm guilty of that every once in a while.
But have you ever shown someone something that you talked about and presented in a presentation in the past and said in the new presentation that this is new information and the photo in question is a brand new photo from today?
Oh wow.
or from the
I
last
had
week.
that one on my bucket.
Have you ever
list.
done that?
No.
So
So-
Occam's razor might suggest that the simplest explanation is he's full of shit.
Yeah. So this is now like the and it's funny because this person, again, takes the screenshots and shows us. But okay, we're not like doing anything. It's nothing we can do about it. This person lives in another country. It's not worth our time. So just let them do their thing. They're just vibing over there, doing stuff like this. So we have as investors just kind of have to be like, oh, okay, and take advantage of it if we can. But anyways, that's what I want to share as a update bombshell back to because I would feel bad if I didn't say that and held it to myself. So because we talked about it, so I feel I needed to say it. But anyways, sorry.
All right.
PayPal.
PayPal, or
One
as
time.
I know it, Pain Pal, because the
PayPal.
price never goes up. But I get the sense that a lot of people got burned by the big price drop. 5-year chart, Ryan.
Oh, sorry. I was getting a little excited. I'm sorry.
Things renormalized for them after the pandemic.
Mm.
That's what normal looks like.
The youth looks at the 1-day charts.
So I think it's partly because their revenue growth did slow down a good amount. Like, so a lot of companies after the pandemic actually had their revenue came down if they were a pandemic business. The revenue stayed not only where it was, but kept going up after, just at a slower level, because the pandemic kind of accelerated their revenue growth temporarily. And then it didn't go down. Their revenue didn't fall, but it decelerated. And that's what led largely to the big sell-off. And then you do have the thing with the margins, which was all because of Braintree, basically, if you look at it. And Alex Chris has come in, and this is actually partly why the stock fell from. It was if you pull up the 1-year chart real quick, just so I can show what I'm about to talk about, because it doesn't really show up very well on this chart. You see how it was up at 90 earlier this year. That was partly because revenue really decelerated, because he drew a line in the sand and basically said, hey, we're bringing in a lot of very unprofitable revenue in Braintree just to win business. But what good is that business doing us if it's hurting our bottom line? And so in letting that go, revenue decelerated down to like 1.5% growth or something for one quarter. And now it re-accelerated again back to like 4.5% or something. And they're projecting it's going to get back to actual growth again in Q3, but probably profitable growth now, because that's kind of the mandate is, hey, we need to grow profitability. They suffered also a little bit from like acquisition fever under old management. They were sort of just acquiring things, and they had this sort of basket of brands and companies under the PayPal umbrella, but they weren't really figuring out, like, how do we make this like a cohesive network? How do we have like an actual flywheel with all of these different things? It was just sort of this amalgam of things that didn't really interact with each other. They were all kind of siloed off from one another, almost completely separately managed under and it really doesn't make sense to do things that way.
Yeah.
And that's sort of, from my understanding, what Alex Chris is slowly but surely correcting. And I think the only thing people kind of knock him for that's maybe legitimate is we've talked about this before, but the whole shock the world thing was a little cringe. But it does seem to me like he's pushing things in the right direction, and there's a focus on not just growth at any cost, but efficient, profitable growth.
Yeah.
And I mean, I think we're starting to see that play out in the numbers. It's just temporarily, the market's still just not maybe totally convinced, or they don't like to see decelerating revenue as we see with this name and other names. But to me, it still looks attractively valued here for sure.
So I looked up the valuation while you were chatting. It's currently trading at a price to free cash flow of around 10, and Seeking Alpha predicts that the cash flow is going to grow by about 20% over the next year. And laws of Peggy, this market cap should be roughly double what it's currently trading at, because you want the growth of the cash flow to be roughly equal to the cash flow, and that's pretty close to fair value. And for it to be half, the company should be worth more.
I actually have recorded videos on me evaluating PayPal in the past, and one of them is actually a reaction to another person that I was asked to react to, valuing the company at 300. At the time, I think the company was like, yes, exactly. I came up with a valuation of around 70,
Yeah, okay.
like that it was a time to buy. At the time, I remember I got pushback because that person was a bigger channel, has a lot of fans, etc. And for me to say that was like ridiculous. So I was a critic of PayPal for some time. Fiscal can vouch for that.
Yep.
And I've changed. I'm actually a bull. And what's changed? Okay, so I changed my mind when the facts changed. So we were dealing with a completely different management team before. And even when the new management team came in, they were unproven to me. And yes, it was a cringe blunder what they did with the "we will shock the world," as Fiscal said. And I think it was a tactical mistake because it reduced, and thankfully though, because that's what gives the opportunity. Thankfully, what it basically did is it decreased the credibility slightly of this management team. I like to look past that. I don't. A lot of let's say the retail crowd will take a lot of let's say anger with that. Right? They'll say like, you promised us a lot and blah, blah. I look more to the actions of the executive, and like he makes a clear plan. He says, and Fiscal was already going through over some of those, but to emphasize it again, right? We're going to focus on profitable growth. With what? With Braintree. What was happening with the predecessor? The predecessor was just chasing sales figures, was just saying, let's get more sales, more sales, more sales. And let's charge a really low price to take away market share from Adyen and Stripe. That is a losing strategy. It's a race to the bottom strategy. And this new CEO comes in and says, let's throw that away and let's focus on making sure the contracts make sense. Let's go back to the older contracts. Let's renegotiate them. And all the new contracts, let's make those make sense. So furthermore, on that note, you won't see that change until Q3 of this year. The management team has been pretty consistent with that, as saying you'll see the reacceleration of Braintree in Q3. Now, where's the part where I come in and say the management team has gained credibility? Well, let's look at the Venmo promise. So this new management team comes in and says, we're going to reshape Venmo. Older management team had this wonderful asset. And speaking of the individuals I speak to who are in the industry of fintech, it's a well-known non-secret, it's a well-known fact that PayPal has completely disregarded this wonderful asset known as Venmo. It seems like they haven't done a lot with it. While Cash App has advanced so much, Venmo has almost remained stagnant with what its innovation has been, kind of coming to market. That's changed a lot recently. And you've seen that the promise was made that Venmo will accelerate. Well, the promise was delivered recently, and no one's talking about that. Everyone's focused on something else, that the promise hasn't come to pass yet.
They said that on the earnings call, actually, because at the end of the call, he was like, well, since nobody asked me about Venmo, let me tell you what we've been doing.
Yeah. So the promise was for Venmo to reaccelerate this quarter. That was the promise. That happened. The promise was never Braintree was going to accelerate this quarter. The promise was Q3 of 2025. Q3 and onward of 2025, Braintree would start to show signs of a resurgence. And resurgence is a strong word. They were focusing on reshaping it and then back to growth in Q3 and onward from 2025. Now, that happens, we got to take a pause there and reevaluate it, but it's just cheap enough that it's definitely not priced for that. I think right now what you're getting at, to Blake, to your point of what you were just spouting before, it's not priced for that. And so on that prior original question of has the value increased, in my view? Well, I was previously, years ago, valuing this at 70 and below as being the attractive entry point. What's changed since then was a lot. The fundamentals have improved drastically, in my view. And now we're looking at a business that's growing, because back in the day, this was a criticism I was levying. They were having decrease in members, right? The people that were transacting on the PayPal network were going down. That's flipped. Now it's back to growth, right? We're seeing that grow once more. And we're kind of seeing some behavioral shift. Oh, the other thing that was very important. So I think that BNPL, if handled improperly, can not be a good thing. Like I alluded to earlier in this episode, Affirm, my opinion has changed on it, but that doesn't mean I think everyone's good at it. I think there are some bad players, just some clear bad players, and not everyone can do it as well. PayPal, in my view, did a really good job at pivoting. So what they did is they took the risk off the balance sheet, and I don't like a business to do too many things all at once. They made a deal with private equity, KKR in particular. They were going to offload the BNPL loans onto their balance sheet, where KKR has more of an appetite. Well, they have this freed up capital that they invest on behalf of their investors to purchase these loans, and PayPal can monetize that, free up that capital, and then focus on what they're good at, which is basically just being this toll booth for money to move through. And they'll still do the BNPL, but I prefer if PayPal tries their best to mostly keep that off balance sheet as much as possible. Let someone else, figure out, how much reserves to put, et cetera, and what their losses are going to be. But you just focus on money go from point A to point B, and I want to take a little bit of that. So that's also changed. So a lot of positive things, in my view, happen with PayPal, and the valuation has gotten better, not worse, and the price is basically flat for the longest time now. So I view it as an opportunity. I have, full disclosure, a position in PayPal. I have it expressed through options. I should also disclose. I got to practice a lot on disclosures.
I have shares and calls.
I'm a PayPal customer.
Well,
I know Ryan was talking about.
I only have one contract at the moment.
Talking about what?
Wrap up, and I wanted to spend a couple of minutes talking about Fabio's fund that he's.
Do we want to talk evolution real quick or Fabio's fund?
Well, we can talk about evolution briefly.
EVTY, Ryan.
I'm sorry.
I just didn't want to miss out on my chance to tell him he's doing his profits wrong.
So this company BlackRock or Black's, what is it? BlackRock? Black Cube. Very interesting company, especially if you're Mike Stathis. I'll say that. And for those who got that joke, it's a very good joke. They're basically, they came out with these secret recordings that's going to tear everything down for evolution, apparently.
Oh, is that why it was down a bunch the other day?
So when I first saw the story come out, I had my initial reaction, which turned out to be actually decent intuition on perhaps what is actually the case. So the allegations were that Evolution had been doing business in sanctioned countries and in countries where it's banned. So let me start with the banned countries where their products are banned, like China. I don't think that they're doing that. I think that it's just the IP theft that they're having an issue with. People are hacking into some of their providers and then getting the product of Evolution in China. But if they were doing that on purpose, I wouldn't really care, to be honest. It's not as much of an issue as the next one. The next one, if true, is a very big issue. But them kind of having a product get into a country illegally, what is the country going to do? They're already banned. Is the country going to ban them twice? They don't do any business in that country in the first place.
Wouldn't they be just business? Wouldn't the strategy for them just be like, go after the people who are using it illegally, since the product is already, like, what can you really do?
Precisely. Yeah. And to be clear, I don't think they're doing that. I think that they're just getting hacked, right? And that product is getting into that market.
Yeah. It's bootleg evolution.
Exactly. Yeah. The one that is concerning, if true, was the Iran one. And any other country that is in that allegation that is sanctioned by the United States. Now, why is that? Because, that would be, the smell test, it doesn't pass. Why doesn't it pass the smell test? Well, the executive team at Evolution would have to be probably one of the dumbest people on the entire planet, as far as executive teams go, by the way, not like just comparison people, but although it's pretty bad. Because effectively what they would be doing is saying, I'm going to risk this massive market, the United States, and its allies, because there's a problem when, the allies of the United States would also abide by the sanction laws. They tend to sanction together in some effect. It's not just one country, but you're risking a lot of big markets for yourself to address a market that I don't want to sit here and give you a figure for the value, but just knowing that it's Iran, probably I can presume that it's a very tiny opportunity for them, given the wealth
I
level.
don't think right now would be a great timing to get new customers either.
Yeah, so it doesn't pass my smell test on that.
Yeah.
And then because again, it would just be incredibly stupid because their growth market, the one they want to attack a lot, is the United States. And so the best way to destroy that is to, purposefully do business in a sanctioned country and skirt the law.
They've literally said that they're going to be like moving away from like unregulated. So like why like it's their strategy to go more towards regulated markets. So like why would you literally do that? Like it goes completely against your stated plan, your right. So,
and Black Cube, fun fact, happened to be Israeli based. Happens to be. I'm not going any further.
Well,
than
it's
that.
also happened to be in a lawsuit with Evolution because Evolution suspects that all this stuff that's happened with Black Cube over the years is because of a competitor or because of a short seller.
Yeah.
The short seller would be wild, by the way, because they do stuff, but that would be like next level.
Mm-hmm.
I don't want to sit here and pretend like short sellers don't, do some wild things, but that would be something very severe. And the competitor thing, there's been worse in history that I can say, like, if that happened, add that to the history books of things competitors have done. Now the part that, to your point, let's focus on the avenue of which it's probably more than likely happening. It's through these VPN channels. So Evolution is a B2B provider, meaning they have distributors all around the world. These distributors use the product. They are the casino. So the unregulated market simply is markets where the governments have not officially made laws on gambling, right? So the United States, Western markets all have laws on gambling. They have age restrictions and the like. So let's take countries in the third world. You name a country, in your imagination. And if it doesn't have laws pertaining to gambling, then this goes into the bucket of unregulated markets. Now, the way Iran is doing it, because they have geo blockers. So Evolution has geo blockers where you can't use the product if you're in certain countries. The Iranian entities are utilizing VPN channels to get access to the product and then distribute. And it's a black market, which, by the way, in Iran, you would think, well, what do you think the gambling market's like there? Is it underground or is it above ground? It's underground. So it's a black market effect. So you're dealing with black market activities, and these exact same allegations were presented in a New Jersey court already, by the way. So it's not really anything new.
Yeah, the good summary.
Okay.
Fuck Black Cube. Do you want to? All right, let's talk about quickly what's going on at CM lately.
So just some summary, and then Blake has a question. You were at CM. We're starting a fund. That's a summary.
Sometimes, yeah.
So I I know you've probably looked at a lot of other funds and what their pay, profits and the fees, the maintenance fees. You chose a 213, and you chose 2 and 13, right? So 2% will be shaved off no matter what, and then after that you'll take a look at returns, and then you're going to take 25% of everything past 13%.
Correct.
So if there's a 17% return, you get to collect an additional 1%. At 21%, you get to collect an additional 2%, stuff like that. I was chatting with Fiscal right before you hopped in a couple hours ago, and I was like, I really wish that was an or, and that the 13 was a lower number. And I think there's a Goldilocks zone of expected returns here. So I know that you and Andrew and Jesse run both long and short. And a huge number of hedge funds, they only roll long. They're stuck. They're stuck in a limited strategy. They're not nimble. They're not dynamic. And for the most part, they're not very good at individual stock pickers. And so I believe that three of you are going to generate average returns somewhere around 30, 40%, something like that. Obviously, you'll have great years where you go above it. You'll have lackluster years where maybe you only do like 5% or something. But I think that your expected returns are going to be noticeably higher than just plain holding the SPY, and noticeably higher than most other managed, especially actively managed funds. So I think you will never have to fear about that 2%. I think that maybe the first year, that's really, the only time you're really going to have to stress about it. And so I think you should say that it's an or, and if the 2% is higher than your profit, you're just going to take the 2%. And if your profit is higher than the 2%, you won't also collect the 2%. But that would mean for you, you'd want to push that 13 down to like 9 or 6 or whatever. You also have the choice of shifting from a 25% to like a 20%. And then that would also want you to shift that number, that 13 up or down or whatever. But I believe that a majority of these hedge funds, they choose this fee and profit fee structure because they know that most years they're only going to get like 10%. And I believe that you guys are going to generate more than that most years. And so you should adjust your profit structure so that you guys make out like bandits and the shareholders are all super happy. And I think switching to an or will produce better vibes, for your shareholders, regardless of actual returns or profits. I think it's an ethical choice where they're going to be really happy the year that you get 34% and you're taking your cut without taking the 2% also.
When the initial survey came out, I think originally instead of 13%, it had said the S&P 500, if I'm not mistaken, when the survey went out. Is that correct?
Cool.
Yes.
So I had made like an almost identical like feedback suggestion to Andrew because he asked, like he sent it in my Discord with permission and asked for feedback, and I was just like, hey, like I think if you made it an either or, but maybe like made your cut if you beat the S&P 500 a little higher would make like something like that would probably give people the security of like, hey, if we're lagging the market, at least I'm not paying to lag the market that year.
The Kathy would affect.
But I understand, like, but he was like, well, that would be like a higher risk on the actual fund itself, which I get both sides of it for sure. But that was just like my initial reaction, like, hey, and I say this as a neutral person that doesn't meet the 200K and accredited requirements to be able to even participate yet at this time. Maybe in the future.
I have answers for all of this because I'll start with actually the last one and go to the other one because I have more to say about it. So on the S&P 500 one, there's actually a reason why we can't do that, or we shouldn't do that, because if we do it at the current size, it's very cost prohibitive. Why is it cost prohibitive? Because as a fund, you actually have to pay the franchise. So like, for example, you want to use the MSCI World Index as your comparative. You got to pay MSCI a lot of money. Bullshit. So that's going to increase our maintenance costs. Yeah. And then same thing with S&P Global. If you want to use the S&P 500 and use it as like your barometer of anything, the fixed annual fee cost goes up. It's basically, I looked at the prices. It will be equivalent to all the administrative costs we pay just to have that tracker. So we can basically do it this way, or we thought about it this way. Our investor base, who we're getting capital from, they're intelligent enough to know what the S&P 500 returns. So we're going to have a fixed hurdle rate that is undetermined right now. We put 13% as the hurdle rate just to put that as like an introductory offer because we are thinking about the investors who start with us, they get some sort of reward naturally because they're taking on the leap of faith, so to speak. They're the startup investors. And so we're thinking, of course, when we finalize it, that it's going to be a much more attractive hurdle rate than what it will be in the future. So like when we have now recruiting investors for later funding rounds, and we already have, a year or two under our belt, those investors who come in later after everything's established and everything looks squeaky clean, they're going to get, something a bit still good, what we think, competitive, but maybe not as like juicy as the starting investors. And then because that in and of itself has to, in some ways be rewarded, like a thank you. Like you guys believed in us from the get-go, boom, here you go. And then actually, yeah, exactly. Free channel memberships. On Blake's point, okay, you're going to love this because we've been having this debate between us for quite some time, and the or has been thrown out a lot. In fact, I'm one of the advocates within the group for the or. Then so we're still not finalized on it because I'm pushing for that or personally. But we're also asking for example, and we might actually end up doing like a a la carte menu for the starting investors. They can choose, because we actually are able to do that. So we talked with our administrator. We can do what's called side letters. It's very common. Side letter is a deal for a specific entity, right? So let's say we get hypothetically like a very big sum of capital from someone, and they say, I want these terms. If it makes sense to us, we can do what's called a side letter. And then if you do, let's say at the beginning, at the start, you can basically offer a menu of fee structures, and you can say like, okay, if you put this amount with us in the beginning, this is what we'll offer. If you put this amount, this is what we'll offer. Or like an example of that, which we haven't finalized yet. But the OR has been floated around a ton, advocated by a good chunk of us. And I'm just going to just speak for myself. I've been advocating for that. But where there's been the pushback is we floated the idea to people who have experience as to far as raising capital. It seems like, for whatever reason, for yourselves, it's easy to market. I don't know why there's a difficulty in marketing the OR to, I don't know, investors who are more experienced in investing in hedge funds. I'm still trying to fully understand that myself, because I think the OR is simple. I think the OR is like, it's either or. It's like, if we pass this, we're going to go for the performance fees. And you say the higher of the two. So that way you mitigate your risk. Because you're absolutely right. It's when you're setting this up, you realize like at least in the very beginning, you have this like, there's these fixed costs every year, regardless. And it's not because like we're trying to, stuff ourselves with a salary. It's like there are fixed costs to keeping just it open and having an administrator handle everyone's account, keep track of everyone's performance.
You have to get a lawyer involved.
Yes, you have to get a lawyer involved. Like all these people cost money. You got to get a tax expert involved, right? So it's like boom, boom. And like I said, you want to add more cost to it. Yeah, you put an S&P 500 comparison, and yeah, you basically double your cost as soon as you do that, which is fine as when you're big. It's super fine. When you're like really large and you want to throw that, payment at it, which I'm actually learned also, it's also complex when you go back and change your benchmark. That's why these businesses are super sticky. The moment you include that as your benchmark, as MSCI Global Index, for the MSCI investors out there and who love that business, the moment you do that, as a fund, you're pretty much never going to change. They can raise the prices on you, and you know what that does to you. Ideally, you're big enough that you can swallow that, right? And you're always going to still run above that. But technically, they have you in their hands, because if you want to go and change that, it's very complicated. You have to go to almost every LP and talk to them, have that conversation and say, hey, we're changing our benchmark. Are you okay with that? You can't just say, oh, benchmark changed. We're switching over to S&P Global. And, oh, MSCI, you can't raise the price by 20%. Screw you. Nope.
Yeah.
So one thing that I think because I'm expecting you guys to produce above average returns, I think you can set your fee structure to be shockingly attractive to people who are only expecting average returns. So for example, you could even set up the fees where it's like 1% flat, and then above like 20 or 25%, you take half. And then some people are going to take a look at that and they're like, 1%, I'm only ever going to pay 1%. Oh, who's ever expecting more than 25% returns in a year? Like there's a whole category of people who are just happy with like 10 to 15% per year. And if you hand them a fee structure that is ultra cheap, if you barely perform or barely beat the market, or only do 5 or 8%, and then you personally get to collect massive dividends on the bumper years, where you like, what'd you do last year, 70% or something like that, or was that 2 years ago? Imagine if you had done that and gotten to keep for yourself, half of everything above 25% return or something. Like, I'm just saying that because I expect you guys to be able to average higher than the expected, you can set up a fee structure that looks extremely attractive to people who are only expecting average returns.
I will say on that maintenance fee, I can say this because we're basically finalizing that. So we're not finalized on the amount, but individuals or investors who are contributing a certain amount that's undetermined above what we expect, they will be getting a fee structure not the ladder, but the maintenance is lowered.
Maintenance
So
lower.
that's already like a guarantee, because we already again, for everyone, if anyone gives us capital in the beginning, whatever the fee structure is at that point is going to be a promotional fee structure, whatever it ends up being. And then later down the line, it's going to be a more not normalized to the industry. Like I said, we want to keep it competitive. And I've been saving at this point for quite some time, where I can go without pay for quite some time. That we can do that, right? I will actually bring up that's an interesting point on the performance one. I'm going to bring that up and see kind of how it's
I believe in you guys. I believe all of you are gonna, like, your team is gonna produce above average returns, and because of that, you should structure your fees to be extremely attractive looking to people who are only expecting average returns.
Yeah, I'm for that, as long as I can make sure that we're not running it at red.
Yeah.
That's the key.
Well,
not running
I'm
it at red.
You've heard of Warren Buffett 0.6. He's 0%, zero flat fee, 6%, and then that's when the 25% kicks in, is above 6%. Not only was he confident he was going to regularly average 10% or better, he was willing to eat the fees in the years that wasn't. He was just, I'll pay it, I don't care. And then you look at like someone else like Monish Pabrai adopted the exact same strategy. He has no team; it's just him. And so if the years he ever has to eat the fees, it's just him. He pays the lawyer,
Well, we've talked about that. If we got big enough, because it's all about size, that's frankly it. It's all about size. And so there is a possibility, like, we get to a certain size, we go back to the LPs, and then we start maybe changing the maintenance fee, and we basically eliminate it. But we have to get individual permission. We can't just change it on you. We have to go, hey, we're thinking about doing this. We're at a certain size where our carry covers all of our expenses and then some. So we want to offer you a reduction to either zero, right? That's actually a possibility that we could do.
Also, you want to consider how you're going to attract analysts. I remember you mentioned something about how you have a team of experts that you're going to rely on. If you're going to promise them some small amount of profit sharing during the bumper years, not only are you going to keep the competent ones that you want to keep, you're going to be able to attract new ones more easily.
Oh yes, of course. I mean, yeah, that's standard practice in that sense. But in the beginning, it's just going to be the team that we have right now, and then if we grow, then we need more people. But we want to keep it lean, though. Just like we're trying to emulate in that way, Dev Kantasaria and the team he's built. It's him, his partner, and then at any given time, a very, very small team. And in fact, we're adopting a general philosophy of like how we handle our investments, like the core stuff. If we're not doing a lot of things, right, not a lot of movement, the better. And in fact, I can share this information, like when you're dealing or negotiating with like the prime broker for where the capital is going to be held. Oh, and this is a question I get asked a lot. It's like how the money moves. So we don't even touch the money. So the way it works is we have the third-party administrator. The investor deposits the capital with the third-party administrator, and then the money gets deposited into the prime broker, and then we get to touch it only when it's in the prime broker, and it can't, because that's a common question. People ask, like, okay, how do I know, that it's not like I can just take it. It's like, no, we can only move it inside of the prime broker, and in the prime broker, the reason why we pay the fees to the prime broker is the prime broker on their end is keeping track of your individual identity and account. Right. And so everyone has their own individual identity account with the prime broker. And then we are paying that fee because that's a lot of administrative costs on their end. And then we pay the administrator to handle all transactions. It's not in-house. We don't have an in-house administrator. That's all outsourced. And in that sense, money goes through administrator, from your bank administrator to prime broker. We have the interaction with the prime broker. And then same thing when money goes out. If someone would request a withdrawal, it goes administrator, request, prime broker, administrator, your bank account.
So you can't just make withdrawals.
No.
Yeah.
We can't. We don't touch the money. We can only direct the movement of said money via the prime broker.
While it's inside that brokerage account.
account. Check the private chat, guys.
Yeah, intriguing.
So unfortunately, I am basically out of time.
You guys can talk after. I gotta just record. I gotta end the recording. Both you two. Where can the people find you before we hop out of here?
Twitter, Seeking Alpha, Discord.
Yeah.
Twitter, YouTube. I almost said seeking out.
You should start writing. You should start
Discord,
writing.
YouTube, Twitter, Discord, YouTube.
I have
Twitter,
a date night.
Discord,
I
YouTube.
apologize. Yeah, Fiscal. They can find you at Mr. Macho Mog.
Yeah, for sure.
Thank you to the viewership for sticking through with us. Without you guys, we probably wouldn't be able to talk to Roger Grover today. So that was pretty cool. Go check out that
If you're
episode.
still listening and you're not subscribed, what are you doing? Like,
Yeah,
you're,
it's
this far into the
like
chat,
you're a
not
mentally ill
subscribed?
person if that's the case. Thank you all once again. I don't know. Watch icons. Don't do dividend stocks, hot drugs, and cash flow is king.